Welcome, everybody, to another episode of the Business Barbershop Podcast. I am Chris,
I am keen.
and we are coming to you remotely this week. Hopefully, you enjoyed our live episode with Andrew last week. If you haven't seen it, it's on YouTube and it's a podcast. Just go maybe Google around. I think you can find it. But I digress. We are here today to chat about something that Keen wants to talk about related to real estate and financing. And per usual, I said, don't tell me anything. Let us talk about it when we get here. So I'm going to turn it over to you. And let's see where this bad boy goes.
Screen share and record, by the way?
Yeah.
Okay.
It's recording right now. You can share your screen and it'll keep recording.
Okay. Okay, perfect.
Just hit the present button.
Okay. Can we pull that up? Present. This is a very basic spreadsheet to kind of talk about what that was worth talking about.
Okay. Love it. I'm a fan of spreadsheets. Let's do this. And then it should pop in here, I think, when you share.
To do.
All right. We got the spreadsheet. Show us what we're looking at.
Yeah, so I'm getting a lot of requests right now. People are saying, hey, I want to refinance, or should I refinance, or whatever. There's a lot of things that go into a refinance decision. Are we changing the rate? Are we changing the term? Fixed to adjustable, adjustable to fixed? Maybe a blend of fixed and adjustable to all fixed, right? There's also the owner's projection of how long they're going to keep the property to make sure that there's going to be benefits, but also there's a projection of what we think the market's going to do. And we have to take all those factors and help try to make a decision. Now, there's a lot of people in my line of work who just phone call people and try to get people to lower payments. But the traditional refinance has fees and there is a break-even point. And we have to take all of the data and try to analyze it. And you guys got to forgive me when I do this stuff, because I just cannot do things on a broad stroke basis only. Oh, it's going to skip the payment. You're going to get this much monthly savings, blah, 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 blah. There's no free lunch, people.
Yeah.
Right?
I agree.
You want to make decisions on a whim. You'll get you're going to get whimsical results, and that's not something that on this show we care to do. Money matters, right?
But
hey, matters, but we are paying attention to the money closely.
Yes. Before we dive into this, can I ask you a random question, but that related to this?
Yep.
Is there ever really a reason that you would want to refinance to a higher rate, or are you almost always going to try to wait until rates are lower and get something that locks in just better numbers?
Yeah, sometimes you can refinance to a higher rate, and you have to understand everyone's personal needs vary. So it doesn't make sense to go from a 3.5% rate to 6.5% rate. On the surface, absolutely not. There's no way in hell it makes sense. However, if someone says, I have a 3.5% mortgage. I was not the smartest with how I took out my mortgage, and when rates were really low, I did a 15-year mortgage and I've been paying extra in principal, but I, in lieu of that, blew up my cash flow by paying extra money towards principal and doing a 15-year mortgage, and then simultaneously racked up a bunch of credit card debt. Now my mortgage is down to $50,000. And I have $50,000 worth of 20% credit card debt. And so even though my mortgage is 3.5%, it's almost paid off. And it doesn't make sense to me to be paying 20% on the other $50,000. So should I just lump the whole thing together on a new loan, maybe at 6-7%, right? And my blended rate's lower, plus my payment's lower, and I'll still pay off the total amount of debt faster, right? That's just an example of how someone's personal situation could be so different.
So you might cash out. So you might do a little bit of a cash out refi, with the idea being you're going to pay off that credit card debt that's at 20% with the money that you pull out, roll it into this little 6 or 7 guy, and your payment will be much, much, much lower, both effectively and from an interest rate perspective, even though technically you're going higher on your mortgage rate.
That's right. Because we have to look at we have to look at the mortgage on a comparison example before and after, as if it's isolated. But we also have to go to 30,000 feet and say, what does that do for you personally, right?
Okay. Yep.
And sometimes people's personal needs go beyond what just a mortgage looks like. Now, there are so many unlimited scenarios where we could get into why you should do one thing or another. What we're going to discuss is primarily the goal that most people have when they refinance, which is, I'm just going to replace the loan I have with something cheaper. That's it. Nothing else. We've done a lot of high rate mortgages the last couple of years. A lot of people are just waiting to be able to lower their interest rate. And so that's why most of the demands are coming from. And so we're going to talk about options associated with those kind of refinances in the current market with most people's goals. Most people's goals, if they bought in the last couple of years and have a high interest rate loan, they're probably not thinking of moving. There's not a ton of appreciation earned yet, but they bought when prices were cheap and they're just trying to get the rate lower so it's more affordable. Okay.
Yep.
So this is I just started putting this spreadsheet together. It's not even close to being easy to understand what's going through my mind, but I'll just try to isolate it so that you can understand. The first cell here is my estimated loan amount. Let's pretend the guy's got a $500,000 existing loan amount.
Why don't you just write that in next to it?
Yeah, I'll do that. Amount.
Got it. Okay, perfect.
This doesn't even really need to be there. Let me just cut that out. Okay. Now these rates and what we're discussing here is hold on here. Let me add. I guess I'm missing a column. Let me add one in real quick. These numbers, they're not 100%, but they're approximately correct for the scenario. This is assuming someone has a $500,000 mortgage, they have a 7% interest rate, they're exploring refinancing, and they know rates are lower. Their only goal is to try to save monthly payments. Let's say they've been in their loan for a year and a half, so they've got 28 and a half years left of a 30-year mortgage, right?
Okay.
What's really driving me to have this conversation is when I see people trying to bait homeowners into these discussions with, legal, but in my opinion, not very ethical or educational bait and switch marketing tactics. So if you have a 7% rate, what's the thing that's going to most grab your attention? A super low interest rate, super low payment, right? Because you're dying to get out of that loan. But man, I cannot recommend more against that for a lot of homeowners. And we'll get into the reasons why. So on a refinance, if there's a thing called the par rate. The par rate is where you're not paying any discount points. You're not getting a credit to help offset closing costs. It's when you figure out and every lender has different fees, their own flat fees. But in general, when you get everybody to quote their par rate, it gives you a good idea of where everyone stands. Someone's fees might be more or less here or there, but assuming everyone's lender's fees were the same, which they're not, but they were, the fees to refinance can range between $4,000, $5,000 as a par price loan for like Washington State, average loan amount around $500,000. Smaller loan amounts are in different areas, fees can vary, right? But that's just assume that's the appraisal, escrow, title insurance, reporting fee, credit report, and these are just fees. People have to understand there's a difference from settlement charges and fees. Settlement charges are fees and prepaid, but only the fees are what your real cost was to do the loan. Prepaids were just money to start your impound escrow account, and interest per diem just covers your loan interest because you skip a payment. If you didn't skip a payment, if you could transfer your escrow balance for your tax insurance, those prepaids wouldn't exist. If what I just said didn't make a ton of sense, I do not want to spend a lot of time on that topic. You need to read a booklet from HUD called a HUD Cost Settlement Booklet. That will break down what these are. But the fees for your loan is your cost to do the loan. Period. That any way you slice it, fees is your cost. Prepaids are not. So your fees will be relatively, in a Western Washington $500,000 loan, right around $5,000. And the only way your fees are more than that is if you pay discount points. Okay. So when a lender gives you a par interest rate, in this case, we're saying the par interest rate is, let's say, 6.25. The lender can opt to give you a bunch of different options. They could say, oh, you can go to 6.25 and pay 5,000 in fees. They could continue to go lower on the rate sheet and offer a lower interest rate, which is what represents that 6% option. That one requires you to pay the regular fees plus a discount point of 1%. A discount point is a percentage of your loan amount. So since it's 500,000, it's an additional $5,000. So now your rate is an additional 0.25% lower, but your fees are now $10,000. You can keep pushing that down, okay, and get into the 5s, potentially into the 4s, depending on the program and so forth. So the most obvious type of marketing that is legal, but again, in my opinion, not the most ethical, is a quote, a super low APR, right? And APRs and rates, when we quote it legally, the APR is different than the interest rate. Again, we won't get into much of that, but it's in your HUD cost booklet. But you can quote something really cheap with the really small, the really small print saying this loan assumes all of the following, right? So of course, people are going to clickbait and get excited about, oh, we can offer a 4.8 loan or a low 5s or something like that, right?
Yep.
Look, guys, if you go to mortgagenewsdaily.com and you look at the average rate being funded in America today, that gives you a good baseline of where rates are really at. Again, that's mortgagenewsdaily.com. So when the lender is quoting something drastically cheaper than that, is their margins cheaper than the average lender? Potentially. But the other question is if it's way below the market, then what are they doing? They're for sure quoting a loan that's either an adjust rate mortgage, which is fine if it fits your scenario, or it has discount points, or most commonly what I've been seeing is a combination of the two, right? And the most basic idea is that if your rate goes from 7% to one of these other options, there's a monthly savings that's going to occur. It's a little bit of a lower interest rate plus a change of your term. And again, we're going to get into the weeds for a second. A 30-year mortgage to another 30-year mortgage is not a true apples-to-apples comparison because in this case, the guy's been in the mortgage for a year and a half. So he's going from a 28 and a half years left to 30 years, and we can't duplicate the amortization schedule. Sometimes we'll give people that option where they can, not by the month, we'll let them choose a 29, 28, 27 if they really don't want to extend the term. But the more we get into that realm, the more we think about things like a pure consumer who all they care about is trying to get out of debt, a very Dave Ramsey type method. And if you're owning real estate and you're a business owner and you have rentals, right? Especially in Western Washington, paying off your balances is not something you usually focus on until you're at the very, 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 very end. Most people are like, well, I have to start now, otherwise I'm never going to get done. The fastest way to pay off your house? Buy a rental. And the first moment you have enough sale proceeds to pay off your balance, sell it, pay the capital gains, and pay off your balance. That will happen faster with less cash than a 15-year mortgage. That's if we get our standard, 7-8% appreciation in our area. So if you understand how to invest properly, especially when there's tax deductions in your mortgage, I'm not generally a person who gets solely focused on debt payoff. I do think people have to be careful with leverage, but if you get overly focused on debt payoff too early, you're thinking too much like a consumer who's never going to build wealth unless you get out of debt. But if you have 50 apartment buildings that are all financed at 50% loan to value, they all cash flow $10,000 net a month, right? Getting them paid off isn't necessary. They're going to cash flow forever.
Yep.
Your loan balance is low, rents are going to go up, right? There's some exceptions to that rule. Maybe some of them have super, super low interest rates and if they get refinanced later because they balloon. But especially in a world of like regular mortgages, if you get like a fixed rate mortgage, it only can get better in time. So when we look at this, we have to say, what really should people do with what the market is doing now? Rates are dropping, but they've only begun to drop. And from all people's projections, we expect them to drop for a while. Now, another thing I'm going to bring to the screen, let's see if you can see it. This was handed to me from a friend of ours, but I'm not going to use their name in case it creates a liability issue associated with sharing the information. This information shared from Bloomberg is showing
Is there a Zoom?
how much.
Do you have a Zoom button? Can you zoom in at all?
Yeah, I think so.
Like
Yep.
up at the top? Oh, yeah.
There we
Keep
go.
going.
Okay.
Perfect. Yes.
This is what the market, for the most part, is pricing into the stock market. They're expecting the Fed to cut rates as much
Right.
as 240 basis points over the next 12 months. Okay. 240 basis points is 2.4%. Now, that does not mean that mortgage rates will drop 2.4%. I wish it did, but it does not mean that. What it means is that the short-term Fed funds rate, which is currently at 5.5, is projected to drop 240 basis points, which will basically drop it from 5.5 to 3.1. And it doesn't move in those 10 basis points; they move in quarters. So when it says 240, that's a blended. Some people think it's going to be 225, but more people think it's going to be 250 because they only move things in 25 basis points
Yep.
increments. Okay, that's why they say 240. So this also does give you a little bit of a scale of, and projecting economic factors is like predicting the weather. The shorter the window of time you're trying to project, the more accurate you'll be. So they're projecting a 0.25% rate cut in September, right? That's going to be more accurate than the 240 over a 12-month cycle. The further out you go, the more likely it is that your projection was incorrect. But this does give you some insight of what we think is probably going to happen. And no one's going to get it exactly right, but we do expect rates to keep dropping. So some people are like, oh, well, maybe I should wait till rates drop further. But there's also the reality of what it means to you now to refinance. Hey, let's just try to do something that can save us money because I'm getting killed with these higher interest rates, right? Maybe I have high rate credit cards, my mortgage is high, whatever. How do I take advantage of lower rates? Do I have to really wait for them to bottom out? And the other problem with waiting for it to bottom out is you still really don't know when the bottom is. So you're trying to wait for something that you don't know at any moment if your timing was perfect. And no one ever gets that part perfect. So with all of that, what should we do? Well, let's go back to the spreadsheet. Okay. I too believe rates will keep dropping long term. I too believe that it's important that if you pay fees for your loan, you recoup them before you refinance. And if we don't know where rates are going to drop to, the only form of refinance that makes a lot of sense to me is what I call the no closing cost refinance. So let's start with 6.25. Let's suppose that's our par rate. That means you didn't pay extra to get a lower rate, but you also didn't raise your rate to get a lender credit. What happens is wherever your par rate is, if you look, let's say that 6.25, and we want to go to 6%, you're doubling your fees from $5,000 to $10,000, right? That's what the par rate is. If you take a rate that's above par, lenders will give you a credit because when we sell these loans in the secondary market, it raises the yield on the investment, right? It's hard for us to get credits these days, but we are getting some. But what we're illustrating is what would happen. Here's our three options. We can take a 6.5% rate, which is going to lower my payment $150, pay a little extra towards principal, but that above par rate gives the person a credit of 1% of their loan amount, which the standard fees are $5,000, which in this scenario is also 1%. So for them to go from their 7 to 6.5, it truly costs them no money.
Okay.
Then there's the 6.25, which is it costs you $5,000. The 6%, you paid extra to get the lower rate, so it costs you 10. So what I did is I illustrated two different time points. One, when did the fees get recouped by the lower rates, not compared to the other refinance options, just compared to the mortgage just the mortgage you have. Like I paid $5,000, it saved me $360 a month. So the 6.25 says it would take 14 months before you even get in the black. You are in the red for 14 months.
Yeah, because you're paying back that 5Gs basically.
That's right. And then the 6% is a larger version of it. We have $10,000 of fees, but even lower rate, and it's going to take 18 months.
Yep.
Okay. So those are two different time frames. If you took
because people think to themselves, oh, I want to be saving $360 a month when I do this. But what they need to realize is their payment will be lower immediately, but they're actually not going to start saving any money for 14 and 18 months.
Yes,
essentially.
that's correct. Now, let's compare that to the no closing cost loan, because the no closing cost loan had no fees. The total interest savings between the change in amortization schedule, that's like a 2-year average, and the payment reductions is about $150 a month. So when you do an apples to apples comparison between the 6.5% to 6.25% to 6%, you start saving money on your first payment. So even so, the next column, this 2,100 and 2,700, is how much money you would have saved in the black for a no closing cost loan compared to the other ones at the break even point. So when you just finally have recouped your fees for the 6.25%, you would have already saved $2,100 on the no closing cost loan. The 6% option is a break even 18 months. And because it takes 18 months to break even, you also don't, you would save 2,700 months, because the other one you would save money for 18 months. Now, eventually the lower rate loan starts to catch up to the other one past its break even point. And it just happens to be that in both scenarios, it doesn't matter if it's the lower rate or the one with the discount points or not, they will finally catch up to the no closing cost loan at the 24-month cycle. But let's go back to the image. This is just the 1 year cycle, right? So how do I save money whenever rates drop, but not miss timing the market? Well, that's easy. If we think rates are going to keep dropping, do no closing cost loan. The lenders will typically want you to keep that loan for 6 payments. It's not required, but they ask you very nicely to keep it for 6 payments, because you get majorly hosed if you don't, right? So the strategy, be honorable with your banker. It would be like getting people to, it's like convincing a Comcast salesperson to sign you up for the biggest TV package on a 45-day trial, and then some salesperson got, a big commission for it, and then on day 44 you canceled and they got hosed on the commission, and you got free TV 44 days. Technically it's a hack, but you totally screwed someone over on the process. That's what happens when you pay off a loan too fast, especially if we give you a credit towards your closing costs. Typically the number is 6 payments. If you made 6 on scheduled time payments, not in advance, we are out of the weeds. And if you decide to do this again, you're free to do so. So the reason why I recommend people to no closing cost loan is because if we project rates are going to keep dropping the next couple of years, we want to take advantage of when rates have dropped some, but we don't want to overly commit to something when we know rates are going to keep dropping down. Right? But you are always taking something a little bit higher than the par rate. As long as higher than the par rate is still lower than what you have, then it makes sense. So in this scenario, if we think rates are going to drop more, that we want to revisit this within a 24-month cycle, take the no closing cost loan, because up to 2 years, this one will still be the cheapest one. You were saving money on payment number 1. So if at 6 months, rates have already dropped enough that you could drop another 0.5% with no closing costs, do it again. Now, there's some general best practices that get thrown out there. I hear a lot of people say, "Oh, you shouldn't refinance unless it's 1% lower." That I don't buy into that whatsoever. Here's where
if it's
that
no
comes
cost, why wouldn't you though? If it
right,
where's that come from?
Anything that ultimately saves you money, it just becomes a return on investment for the time it takes to do the loan. Which, if you have a mortgage banker that's got all of your info, that's ready to do this for you every 6 months if rates go lower, doing the second and third and fourth one is really easy, because they just get updated finances, right? So the effort should be minimal when it only gets you onto this strategy. And this strategy really works best when rates are high, they're on a decline, and you can't tell how long it's going to keep dropping or how low it's going to keep dropping, but you don't know, but you want to be able to save some money along the way. So if this person at 7% and they go to 6.5 with no closing costs, they save 0.5%. Payment savings is number 1. Here's the other thing too. Where that 1% best practice comes from is all based off of national averages. The national average is that the home prices are about $300,000. The national average is that people owe about 80% of that, which is like $240,000. And on the $240,000 loan amount, if the average fees were, let's say, like $4,000, you need to drop your rate at least 1% to start saving money by around the 2.5 to 3 year mark. And the average person keeps their house about 5 years. So they're kind of using this as like a, hey, you'll probably save money. But that's making all these, generalized assumptions that aren't particular to you. 0.5% of a $500,000 mortgage is the same amount of dollars as 1% on a $250,000 loan, right?
Yep.
We're talking math here. 0.5%
Yes.
of 500 grand is the same amount as 1% of 250 grand. It's a function of yield of rate versus the actual dollar amount. If you want to save X amount of dollars, you either need to drastically reduce your rate if your balance is small, or get a small reduction on a very large amount. If you have a $5 million mortgage and someone offers you a no closing cost loan, even a quarter lower, you should be jumping all over that.
100%.
That's still a lot of interest, right?
Yep. Does
So
it, would you still, so to make this clear, let's
yes.
say you did have the 250 house and this scenario applies, it still would make sense to reduce your rate with the no cost close, right? I mean,
Yeah,
what
this strategy technically
the
makes sense
this
regardless of
yeah,
your loan amount. However, it's
the
easier
savings
to
will
do.
be smaller. Yeah.
Yes, yes, the savings will be smaller, and there's a problem with doing smaller loan amounts. When I say that the standard refinance fees are about $5,000, right? A lot of those are flat fees. Some move on the loan amount, like title insurance.
Yeah.
But a lot of them, like the reporting fee, the appraisal,
Yep.
credit report, have nothing to do with the loan amount. So what happens is as your loan amount drops, your fees don't necessarily get way smaller. And remember, whether it's discount points or for a lower rate or credit for a higher rate, those are given back to the borrower in the form of a percentage of the loan amount. So remember, look up here and see how the discount points was 1%, which is why it was $5,000. So that means the credit for 6.5 is also 1%, right? I put like a negative 1%, right? And it's make $5,000, and that's a credit for 6.5%.
Oh, got it.
Right.
Okay.
So the problem with the strategy of doing it on the smaller loan amounts is you sometimes have to keep raising your rate a lot to offset the flat fees to do a no closing cost loan. So the one problem with the strategy is it works best for the larger loan amounts for this reason. It's a smaller
Well, there becomes a
to
point.
offset the flat fee.
There becomes a price point where it makes sense, basically.
Yeah. Which is
A price
coincidentally
point and up.
Yeah, coincidentally, the smaller the loan amount, the more it makes sense to refinance in general, because now you're just same thing, same flat fees, but you're lowering your rate, but the balance wasn't that big, right? I've had these discussions with homeowners like, hey, you know, I'm dropping my rate from 6 to 4, but is it really worth it when I only owe 60 grand? I'm like, no. Like, why pay 4 grand in fees, lower your rate 2%? Right. That 4 grand could just be 4 grand off for principal, and we're splitting hairs how much it would save you if you did a refinance, right? Because there's a point where the loans get really small, it doesn't make a lot of sense. And in a similar fashion, right, the larger loan amounts, it's easier to get a credit offset your fees as a percentage because it's a smaller percentage of the loan amount. So, but in general, when I get people who are in this kind of like a 400,000+ loan amount range, which is very common for Western Washington, this is what I'm recommending for people. Again, we're not talking about shortening terms, ARM versus fixed, cash out. That changes everything. If we're just talking about reducing our interest rates, the current lending environment points that rates are going to slowly decline over a period of time. You want to take advantage of it when they do drop, but you don't want to overcommit in fees to doing any particular rate with the knowledge that they're going to keep dropping down, which is why I wouldn't pay, you know, let's say that someone says for 3 points, right, which would be, in this case, 15 grand, 20,000 in fees total, I'll get your rate to 4.8. Yeah, your break-even point is going to take years. Right. What if you end up getting to 5.25 on no fee loans over the next couple of years? And then at the very end of that time, not only did you save money, you know, just kind of dropping with the market, you're always just funding a little higher than the market, but still lower than your previous rate, you're kind of floating down with the market, taking advantage of part of the gains as it happens. Someone doing like dollar cost averaging on like their investing, right? If there's a moment where you feel like it's bottoming out, and you say, now's the time, I don't mind paying a little extra fees to get a lower rate. That's the time to pay the fees, when you feel like it's not going to go any longer, but you also have to weigh into something else. The minute you pay into the fees, you also have to, you may have said, okay, I have projected that rates are going to come down any further, but before you do that loan, you better just do one more projection, which is when rates are at their very lowest, if you decide to maybe take the par rate or maybe even pay discount points at that time, because again, right, you feel like they've bottomed out, you still have to ask yourself, do I think I will keep this property for more than X amount of years, right?
Right.
Your ownership goals. So let me flip it in reverse. Rates were dropped down to about 2.75 in the middle of COVID, right? For owner occupied.
Yep.
And the interest rate most people were getting on rental properties at the time was about 3.25, about 0.5% higher, right? Is the extra premium for a rental property. At the very bottom of the market, I took a couple of properties that we had just purchased, right? And refinanced them. And I not only didn't do a no closing cost loan, I paid almost 2.5 points on each one of those loans and pushed them all the way down to 2.25. And on the outside looking in, I had a lot of people who I said I did that to criticize it. They're like, well, 3.25 is already great. Why are you paying, at the time for all three mortgages, because all of them were right around like 400 grand. Why would you pay over 20,000 in discount points to push from 3.25 to 2.25? I did the math. The break-even point was like 6.5 years, right? Like, oh my gosh, that's a really far break-even point.
Yeah.
But I just bought the property. It was in West Seattle, where it was going to take at least 2 years for the bridge went back up. Rates were at their absolute lowest. Zero intention to sell the property ever, right?
Yep.
And so I said, well, I project that I'm going to keep it beyond the 6.5 years. And I also project that the market's not going to go any further down. So this is the right time to technically do it. And for a lot of people's initial reactions, like, well, 3.25 is so good, why would you need to make it better? And it's not about like how 3.25 isn't good enough. It's just about making the right decision for the market and your plans. And if my plans are for long term, and I believe the market is at the bottom, that was the smartest thing to do. So when I did that, now fast forward, we are 4 years past that decision. And over that period of time, I did a handful of different strategies. That wasn't the only property I refinanced during that window. Some of the other ones, I'm like, okay, I don't want to pay a bigger loan amount. I just can't tell if I'm going to keep it forever. Maybe I'll just do par. Almost every single property that I took par pricing afterwards, right? I regret not doing what I thought in the first strategy. So we all make mistakes. My first thought was correct. And I kind of went against it on some of the other ones. I'm like, maybe I keep it for 6-7 years. Maybe I don't. I don't know, right? But but all those properties are way more valuable because they're on a lower rate loan to me than they used to be. And knowing that makes it easier to keep them long term. And that's why it was a mistake to not like overcommit to them, right?
Plus, once you get to year 6, once you get to year 7, then it's like you're not necessarily going to feel this, but that's a lot of extra money coming in. Like it's a significant savings.
Yep. And what happens is too, is people get sometimes confused and they look at the payment savings. Like when I put here monthly, if you notice, they say I put in here on the spreadsheet monthly savings, I put payment difference plus principal. The reason why I put that in there is because a lot of people mistake that the payment difference is your savings. So because there's a change in your amortization schedule, those payment savings in the spreadsheet are rounded figures of the 2-year average of difference in principal plus the payment difference, because you're changing the schedule when you change your rate and you change your term. Does it make sense?
Yeah.
It's always a moving number, which is another reason why when you're at the very bottom where rates are low, it's a mistake to only look at the payment difference. Like, so when people said like, oh, well, look, you paid 25 grand in fees. Well, I could tell it's only saving me $400 a month. That seems like it's going to take forever to break even. The closer you get to zero, the more your lower interest rate starts to apply money towards principal, because it's still got to get everything paid off in 30 years. And we're far from it. I don't think it's ever going to come back again. But 2.25 is a very special 30-year fixed interest rate. Do you know what's special about 2.25?
No.
2.25 is the first interest rate, assuming that you're moving in eighths. So 2.25, 2.375, and eighth higher, 2.5. So typically mortgage lenders move rates in eighths of a percent, 0.125%. 2.25 is the first interest rate that is, when you move in eighths, that is so low that on payment number 1, you're applying more than half of your payment towards principal. A lot of people think, oh, you pay only interest at the beginning and principal at the end. Well, that's because on an amortized schedule, if this is a sliding scale of your interest, you pay more interest at the beginning, less interest later on. If you look at the scale of your principal, it makes like, and you overlay, it looks like an X. Principal is less at the beginning, and it goes up over time. But as your rate gets closer to zero, the X starts to flatten out.
Yeah.
Right? At one point, your principal actually exceeds the amount of interest on payment number 1, but the acceleration still happens, like on any other amortization schedule. but it starts at over 50% at 2.25. So
That's
now that we're
crazy.
4 years into it, not only do we have the absolute cheapest payment on those 3 refinances we did, but the principal is just melting off,
Yeah.
right? Because now we're 4 years into a schedule that started at more than 50 per principal, and now it's getting closer to 60, 65% towards principal, right?
Yeah. So you have to think, instead of when you're making that payment, what you really want to deduct as sort of lost money is the interest.
Mm-hmm.
The other part you really have to think of just as like reinvesting it in the property, and you're going to be able to extract that at some point in the future, whether it be a sale or a cash out refi, or it is money that is yours. You're just moving it to a different place,
Yep.
essentially.
I
You're
mean,
converting it
here's
from
what.
cash to real estate.
Yep, and there's a lot. When you get people take it. This is the reason why cheap lenders and discounted brokers. It's if you know exactly what you're doing, getting the cheapest loan may be a fine decision. But making the best decision for yourself in that space, to me, is very similar to like, well, I don't need a financial advisor. I'm just going to buy my own stock. Well, if you can do as good of a job without paying them to do it, then yeah, sure, why not, right? But the reality is the best financial decisions for people are usually when people have the knowledge and also the ability and personal self-control to execute a plan. And
Yeah.
that plan is, I go to 100 feet to runway on each one of these factors, and I go back to 30,000 feet and say, I'm going to analyze all the 100 feet to runway analysis, and I'm not going to get hyper focused on any one of them, but what combination of all those finite little pieces of data will result in the best financial decision. And sometimes people act like financial decisions are like this thing that doesn't have to do with math sometimes, and I don't understand where it comes from. Like, what happens is like you'll get like 3 people who have differentiating opinions, right? And
Yep.
they act like everyone is right. And I'm like, I don't want to sound like an ass, but my reaction is, if the person who's taking this advice will 100% do whatever the advice is, so we're going to take off the table of the personal decision and self-control part, right?
Yep.
We can layer that if you know the person, right? But if you're going to ask just the question, what will make you the most rich, right? Period. Some of it is going to do some projections of what we think the markets are going to do, but the right person is going to do the correct projection, and they're going to be right. One answer will make you more rich and one won't. And under those circumstances, there's only one answer that's right, that one, right? And so the truth is that this strategy is isolated for the person who only intends to save money on their mortgage. We're not talking about cash out, shortening terms, whatever, or that they're better investing in the stock market with a saving, finding a rental property, whatever. We're just focusing on this property. So this is that 100 feet of runway. But what I like about the strategy is if you don't want to think on a 30,000 foot level about your personal finances every single time rates drop, but you do want to take advantage of where the market's going, it doesn't hurt you to do this strategy if you're eligible for it over and over and over again. You're always just kind of picking a rate that's about 1/4 or 0.5% above the par. But if that rate is still lower than what you have and we're still on a decline, get some right now savings, but don't overcommit. If you decide later on, like, oops, I should have done a cash out loan. Great. Well, the last one didn't cost you anything. Take some cash out on your
Yep.
next one, right? Oh, maybe I should have done a 15-year mortgage. Okay, great. The last one didn't cost you anything. Do it on your next one, right?
Right.
Whatever it is, right? And what's your worst case scenario? Maybe when it got to the very bottom of the market, you didn't time it perfectly and you missed a chance to pay fees then, and it went up. And your last chance to go a little bit lower was lost. You didn't pay the fees at the very bottom. Well, you still did it near the bottom. If you're anywhere within 10 to 15% near the bottom from the total slide, you're doing pretty well, right?
Yeah. Yeah.
And
Let me ask
that's
you
kind of
this.
my point.
Is it unreasonable to, let's say you were my lender, right?
Mm-hmm.
To say like, hey, Keen, can you like put a notice up and let me know when the par value gets to blank?
Yeah, totally, 100%. But
Because
usually it
you
starts
kind
with
of know
a
if
kind
they're
of like
going
a high
down.
level conversation like this, so that
Yeah.
when the rates move, we know what to do based off your scenario, and then we
Yeah.
track the market. And when it's at a certain point, we just alert and say, "Hey, now's the time to do it," right?
Right. Yep. Yeah, because there's no reason. Why wouldn't you? The only thing I guess you also need to factor in, if you think things are going to go down quickly for some reason, would be you really don't. Every time you do this, you're not technically, but you should consider that you're locking in for like 6 months, right? Basically,
Yep.
so you want to think, okay, I'm gonna have to, whatever I'm doing, I'm probably not going to make a move for another 6 months. So if I think it's going to go down a little bit more for whatever reason, then maybe you'll wait an extra 30 days or something. I
You
guess,
could,
I don't
but
know.
here's the
Yeah.
problem, right? It's still like what's better, one bird in hand, two in the bush? You're
Agree.
only
Yes.
hoping rates are going to drop. And if they do drop and it's a long-term trend down, what did you really miss by locking in now? Maybe you waited 2 months to get a little bit lower rate, but then you're
Right.
2 months sooner from revisiting a potentially lower rate again after 6 months. And we're at the beginning of the slide. If we really think the slide is going to go over multiple years, 2+ years, then you're not really losing that much. Take the money in the hand, and we'll see, right?
Yep. Yeah. It's badass.
Plus, people, when you start to refinance, there's a process to do it. It takes about a month, right?
Yeah.
And you could say, great, I'll start the process and maybe I'll float it. Like, I would say that, sure, what you just said, I still wouldn't stretch that past the point of like, I'm not even going to apply because the rate's going to drop. Well, it takes 30 days to close, and you can technically go through the refinance process floating and lock it just at the very end, right? If there's enough that it benefits you now and you're going to do the lock float game a little bit over a couple of weeks, start the process and then lock it closer to the end of, like, with the 30-day process, lock it, and lock it in 2 weeks in instead of right at the beginning, right?
Yeah.
But I wouldn't delay on doing the whole process until that point, because it takes time and effort to do it. So just get that effort up front, and then if you want to play the rate float game for a couple of weeks, do it, and then after a couple of weeks passes by, lock it, and then close it. And if your timing wasn't perfect, oh well, do it again in 6 months.
Right. Yeah, but you're still better off either way. So it's not like, you're right. I think it's worth it to pull the trigger when you hit that point.
So what if it flips? What if something weird happens to the market and you lost that chance? Just take it, and then it's still, if the long-term side is lower, somewhere down the road you'll get that opportunity again. If that opportunity never came back, what did you lose? Oh, it went down a little bit, then it started going up again forever. I should have paid extra fees to get a lower rate. Well, you still got something, and you're only 0.5% above, quarter 0.5% above the par rate. Again, in the big scheme of things, you're always getting near the lowest rate every time you do a no closing cost loan. You're just a couple percentage points above it, and as long as that number is still less than what you have, you don't have to worry about these particular calculations that you're seeing here. Did I have to wait 14 months before I even broke even? Because if you say, well, I think rates are going to drop more in 14 months. Yeah, but be crystal clear. 14 months is when you finally got out of the red. You still would have saved more money on the no closing cost loan at 14 months. At 14 months, you would have saved $2,100 on this $500,000 mortgage compared to the par price loan. It would take a full 2 years for the lower rate to catch up to the no closing cost loan. So the only reason why you pay the fees is you believe that now is the right time to refinance, where you're not going to have any options to get something cheaper beyond 2 years. And based on what I just showed you, that's probably not the case. But waiting 2 years doesn't make sense either, because A, we don't know where the bond is going to be, and if you can take some of the savings now at no cost, why not take them?
Yes. Yeah, it's hard to, I mean, I think this just goes back to the general discussion that we have all the time about trying to get rich quick, or trying to like maximize any one singular move. That's just not really the way that the world works. If you are successful and wealthy, you when you see opportunities, you take them, and you don't really worry about if it's literally the best you could have done. If you could somehow see into the future, you just wait for the next good opportunity to come, and then you grab that as well.
Yeah, it's so much of this, even though it's not investing, the mindset that goes into this so often is so similar to like the way that people invest. What I'm recommending is hey, you'll capture 70-80% of all the good you could ever hope to happen, right? Maybe you didn't time it, maybe if you just move around your timelines a little bit or change around your strategies, you could have got an extra 10-15% better total savings over a period of time. What's the version that we can capture 80% of the absolute best case scenario, but eliminate all of the downside of any of the other decisions?
Right.
right? That's
Yep.
really best investors do a version of that because there's a weighted risk to benefit. To get that last 10 to 15%, you could have potentially blown everything. That would be very similar to someone saying like, oh, S&P 500 gives me between 9 to 12% a year, and I really believe in NVIDIA. It's made great returns, right? Oh, well, then let me just, and I think that the NVIDIA is at its lowest right now. So I'm just going to move everything I have into NVIDIA right now. It's like, okay, having a blend of both to be diversified could make more sense. And also, like, not trying to time the purchase all at one moment, maybe dollar cost or value average to wait
Yep.
out your return. Because remember that, Warren Buffett only has 2 rules to investing. The first rule is don't lose money. The
Right.
second rule is don't forget the first rule,
Yeah.
right?
Yes.
What people get missed on is that the compound interest returns in investing work against you when you have down years more than you think. You need it to, even if it's a little bit, be upwards, let it keep compounding upwards, right?
Right.
The only benefit of down is that when you're bringing new money into the market, you get to buy it at a discount, right? That's how you, and
Yeah.
that's how you help leverage. That's how you help offset, short-term losses in the investments that you have. Is you put more money in when it's lower, which is the exact opposite of what most people think to do because they react way too emotionally. The same emotion that makes people do a 3-game parlay and gamble and say, I don't invest. I'd rather just try to see if I can get a 6,000% return by doing a 3-game parlay in the NFL, on the Sunday. Is the same part that says, like, I'm willing to take losses for that huge upside. And you already know how the long-term result is of that kind of thinking.
Yep.
Usually it results in being broke, quite frankly. It's definitely not a way to make money. You might make money in moments of a time, but the philosophy is it doesn't work.
Yeah.
It's flawed.
Yep. No, that is cool.
Yep.
I didn't know about this, so I learned something new today. I think we
Well,
should
not
just wrap
only
here
that,
if we're
yeah,
done.
and not only
Yeah.
that, but it's like it really this becomes such a hot topic because rates are lower now. And it's like, okay, if you have 7% and someone sends you a flyer saying they can get you 4.8, it's like, okay, what if it's an FHA loan, has mortgage insurance, your fees are astronomically expensive, right? And rates are going to keep
Yep.
dropping in the future. That's just the worst advice. But you'll definitely get more clicks right now, right, on advertising and stuff like that. But man, I had to get this out there because based on the market conditions and where we're at, what I think being marketed the most is the worst advice based on what the market point is going to happen. It's not even close to being the right advice.
Right.
Maybe our hedges are wrong. Maybe rates only go, maybe this is the lowest rates are going to go. If this is the lowest rates are going to go, then those sales pitchy marketing people pay a bunch of discount points to get in the fours. Lenders would be right. But I might not
If
bet
you're
my
going to
left
stay in
arm
your
on
if you're going to stay in your house for a long time.
stay in the house long term, and you think the bottom of the market is right now.
Right.
I'm not saying that I'm going to bet my life or my left hand that they're wrong, but if they want to make a wager that they're wrong, I would give them really good odds because I do study economics, and I'm pretty sure they're going to be wrong.
Yeah. Well, you just
Technically,
never
the
know.
Fed
That's
hasn't even cut rates yet. They've
right.
only said publicly it's time to start looking into cutting rates. We just are past that tipping point, and now you want to pay all the points. Remember the story of why I paid the points when rates are at 275, right? At the time, people thought I was crazy. 2.5 points, rates are already so low. Why are you doing it? Now, when we talk about the math and we look back, oh my gosh, that was so smart. I can't believe I didn't do something similar, right? So often the right decision is very, very contradictory to the movement of the crowd. And math is
Definitely.
math. It's weird to me how people sometimes look at math and they have emotional reaction to it. They go, like, that's too good to be true, so I'm not going to believe it. Well, I think is 1 + 1 equals 2. Is that too good to be true? Because that's just math, right?
Yep.
Similar to like compound interest. Sometimes people think it's too good to be true, so they don't believe it. Math is math. It's a real thing, right?
Agree.
Yeah.
I agree. 100%. 100%. All right, cool. Hey, this is good. Let's wrap it up.
Yep.
We don't need to talk about anything else today because we're almost at an hour anyway, and no need in gumming it up. This was really good.
Yeah.
So this was cool. It also, by the way, this having this strategy in your back pocket, I think also makes purchasing when interest rates are a little bit higher, a little bit easier. Just because you know that there's the opportunity to do this if you're just kind of paying attention over time,
Hmm.
because sometimes you just may catch it when it's a little high and you just but that's fine because you kind of stair step it down over time if you when the opportunity arises, essentially. Because just
Right.
think, because what we're like in the eights for a time, right? I mean, we were
Yeah.
in the so like if you bought at an eight, you might be like, gosh, well that's really sucks. But if you could come in right now, you could come in potentially like at 6.5 right now, right? With
Hmm.
the no cost close or whatever. And that
Yep.
would be pretty ridiculous, and and I think knowing that those opportunities are out there changes your philosophy a little bit, particularly if you think like, look, this is the highest these things are going to be. There's most likely, right? And then you're
Yep.
still, if it's not, then you're still there. You're still at 8 and you're fine doing your thing, basically waiting until you have an opportunity to make a move. So,
Again, the strategy doesn't. The minute you start mixing too many other things into it, we have to twist the strategy around a little bit. But
yeah,
just on the surface, changing one mortgage to the next. If you think rates are going to continue to drop, right, then the strategy
yeah,
makes all the sense in the world. And it's the
right,
exact opposite of what's being told in the large masses. And
yeah,
so, I know it's easy to get sucked into it. Man, the payment savings going down to in the fours makes it sound so good.
yeah.
But, you know,
But the math doesn't work because of what you have to pay up front. Because you're sort of, in a way, you're prepaying the interest to somebody else in those fees.
yeah,
You know what I'm saying? You're
it,
not
it,
really
it's a it's a very different scenario, but has similarities to it. You know what this reminds me of? Let's
what?
suppose that you're looking at buying a Honda Civic. Someone's
Okay.
offering you to buy a 2-year-old Honda Civic for 30% less than what it was brand new Blue Book value, used. And you're like, this thing's
Yep.
going to last for 400,000 miles anyways, and it only got 10,000 miles on it. So the difference between that and new is almost nothing, right?
Yep.
And then the used car interest rate is, let's say, 4.5%. And the dealer's like, oh, but if you buy new, we'll give you 1.99% financing.
Right.
Oh, well, the rate's lower. Well, just do the math, right? Was paying an extra 30% more in principal costs worth being 2% lower in rate? There's going to be a point. At first, you're in the red for doing the new
Yep.
car, and many years down the road, right, it will eventually maybe catch up potentially. But
Yep.
in a similar fashion, if rates are going to keep dropping, you might end up at 2.5, 3 on a car refinance before you're done on the original car that was principally less. You wouldn't want to start with a more expensive car and just get hosed on the principal value right out of the gate. This
Right.
is what's happened. The principal cost you paid for your house goes backwards when you pad in a bunch of fees to do a refinance. It's no different.
Yep. Yep. Agree. Okay, cool. Sweet. All right, let's wrap it up. I mean, that was good. I don't even know if there's any need to sort of recap. It kind of was cool. All right. So let's just close it up. So by the
Yeah.
way, if you need some help with this, I bet you can call Keen and he'll hook you up. So if you see this and you're curious, reach out to him because you know what?
Yep.
This is kind of what he does. All right.
Yeah.
So that is it for today. I'm Chris.
I'm keen.
This is the Business Barbershop Podcast. See you later.
See you guys later. All right.